Hi guys, today's lesson is about Elliot Wave principle. What we're gonna do here, we're gonna go over the basics of Elliot Wave. We are not gonna talk about anything really detailed. Elliot Wave theory is extremely complicated. If you go ahead and buy a textbook about Elliot Wave, it's literally the size of the Bible. And honestly, in our trading style, Elliot Wave detail is not important. We're just gonna go over the basics, and the reason why we have to is because we're gonna need the Elliot Wave basics to understand Fibonacci extension and retracement, and a couple of other indicators. You need to understand the basics about Elliot Wave just to know how to use them properly. Now, before we get into the main of the subject, a disclaimer is this channel does not intend to replace any trading and coaching programs. It's a deep introduction of the world of trading, crypto, and stocks. The series of this channel must not be considered as financial advices. Our contents are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. Alright guys, book is coming, so bear with me. Now, Elliot Wave principle. Now, Elliot Wave, the technical analysis theories. Many people think that Elliot Wave is just one theory. Elliot Wave. It's I guess the thousands of suggestions and principle. But like I said, you only need the basics. There's no need to go in detail, study with in detail when you're a swinger, because our main goal is to develop sets of skills in which we're gonna catch major swings. There's no need to count wave. For an example, like I'm gonna show you, there's no need to count 10,000 wave. If you can just catch this wave right there and follow, ride, and keep moving your stop loss all the way up. We don't care about reverse. We're not looking for top or bottom. We get stopped out, we take the money. That's matter to us. So we don't need anything complicated about Elliot Wave, just the basics. Okay, so like I said, people use them to analyze financial market cycles and forecast market trends by identifying extreme in investor psychology. The basics, that's all we need to cover and master swings. Now, let's analyze the wave by assuming a bull market. So we're gonna do it in like we were talking about bull market. They consist of impulse phase and corrective phase. The way that the market move in any direction, it's a set of impulses and a set of correction. It doesn't matter which time frame you consider. Same things happen in monthly time frame. It's just 6 more times, and same thing happen in 1 hour, 5 daily day trading time frames. It's impulses and correction. Now, impulsive wave, they are made of 5 waves. So one impulse it's made out of 5 waves. They call them dominant trend. So you have wave 1, wave 3, and wave 5. Usually something like that. I'm gonna show you, but we can try. Show you something. So an impulse wave is made out of 5 waves, like 1, 2, 3, 4, 5. Okay. Now this is 1, 2, 3, 4, and 5. So usually wave 1, 3, and 5, 1, 2, and 5, they are impulses, and wave 2 is the correction of wave 1, and wave 4 is the correction of wave 3. Now, corrective phase, they are made out of 3 waves. So after this entire thing right there is an impulse. Okay, so a corrective phase is made out of three phases. Corrective trend, so we have a dominant trend, a corrective trend. We have made out of A, B, C. Now these are the basics, okay? It's usually way more complicated. To every Elliot Wave counter, they will tell you that they have this trick there. We're just gonna go over the basics. That's all we need. So with A and C are impulses. So, and wave B is a correction wave from wave A. So A, B, C. Okay. Now this is A, this is B, and this is C. Now, what you need to understand is that this thing is the impulse, and this thing is the correction or corrective trend, dominant trend, corrective trend. Let's go over this. Now, I have a detail, more fun here. So this is wave 1, this is 2, this is 3, and this is 4, and this is 5. Now, wave 1, this entire thing is an impulse. That's the impulsive way, the dominant trend, and this entire thing is an impulsive phase. In this impulsive phase, we have 1, 2, 3, 4, 5. Now, that's a correction phase, okay? And this entire thing is the correction phase. So you have one impulse, a correction, one impulse, and then after that we're done, usually. So impulses, they are all made of 5 waves, and correction usually 3 waves. Now this whole structure right there is the entire Elliot wave cycle, and that will put us somewhere here where this entire thing represent one cycle. So that's a cycle. Okay, so moving forward, the wave 1. Now every single wave, when we're gonna go over and study those impulsive wave and stuff, they have a couple of sets of rules based on billions and billions of people doing shorting. Now the first wave is usually a first wave of bull market. Now remember, we are doing this like we are considering a bull market. So the first wave is usually in first wave of bull market. Fundamental news, the all negative. Usually the first wave in a bull market, the first wave that starts a bull market, happens when everybody is literally negative about the market. Things are very bad and everything. It is difficult to identify, especially when it's early. The price might go up, but volume generally is not alarming enough to get that technical analysis attention. Not just the technical analysis attention, I think it's all, for example, all on media attention, public, the entire thing generally is something that everybody is staying away. For example, at a very end of the bear market in a stock market, nobody wanna hear about investing. If we have a bear market in a housing market, nobody wanna hear about buying a house. Same thing for crypto. The very end of the bear market and the very beginning of a bull market, nobody wanna know about buying crypto. It just don't talk about that. So usually everybody is negative about that, and usually this is where you get your first one wave, this one right there. And then after that, this wave right there, like I said, people have this is the first impulse, also made out of 5 wave. This first impulse right there, like I said, usually people are very pessimistic. Same thing happened here when we have a first impulse of a corrective phase or a change of the trend, reversal. People are unbelievably positive about the thing. 1, 2, 3, 4, 5, that kind of stuff. Now, the wave 2 correct the wave 1. Now, in a bull market, it's a retracement. In a bull market, it's a retracement. In a bear market, impulses, they are, for an example, you have an ABC, something like that, and that impulse is also made out of 5 wave. 1, 2, 3, 4, 5, sorry. And then this is an ABC, then 1, 2, 3, 4, 5, that kind of stuff. So you have a retracement. So you have the wave 1 retrace on itself. In a bull market, in a bear market, you have a wave 1. That's not they call them bull rallies. So it really depends on which trend are we talking about. So the wave 1 will never reach 100% retracement. News are still bearish. So people don't want to talk about this field. It's terrible investment. Don't stay away from it. Now this is the wave 2. The wave 2 should never go all the way back and retrace on itself. If you see this is not a first impulse on the way up. No, we should not retrace on ourselves. This is a big sign of reversal anytime you have a wave that retrace on itself. It doesn't matter. For our time frame, I see this, I will probably get stopped out here, and I will probably not looking forward to enter again, because I get stop loss usually I get stopped out when there is a major change of the direction of 1 and 4 hour time frame. So here it's a retracement from 1, and we should never go 100%. In that case, this is not the first wave of a new impulse. Now the wave 3 is also an impulsive wave. It's usually the largest and the most powerful wave in the trend. The wave 3 is never the shortest. News are positive all over the place. Fundamental analysis start to raise earning estimate. This is the moment you hear, Bitcoin 200,000 K and that kind of stuff. Tesla 1 million per stock. News are, fundamental analysis are all over the place, doing all sorts of estimation based on, based on how they sleep last night. Now correction are short and shallow. So on the wave 3, you get small correction, and we keep going up. People are buying the dip. It's fine. Everybody is a genius. We're going up. Everybody is super great trader. I mean, everybody's making money. Those waiting for pullback might miss opportunity, because the thing is that the market literally don't really pull back on this situation. We just keep riding like it's like it will never end. Wave 2 is just persistent. The most persistent thing you will find you'll have to face as a trader, especially the wave 3. So this is right there is the wave 3 for an example. That will be an example here. Okay, so it's an impulsive. There is impulse in wave 3 too, and that stuff keep going up. It's going up. It's going up. Good news, everybody's making money. Every traders are smart. This is crazy. Every traders are smart in the wave 3 exactly. And after that we have the wave 4. Now the wave 4 is a clear corrective of the wave 3. Now wave 4 is very interesting, because it's actually, most of the time it tends to be a flat correction in a sideways fashion. Wave 4, in wave 3 we can have a longer wave in term of progress. For an example, a progress of 1,000%. That kind of stuff is very possible in Bitcoin. But the wave 4 can be longer in terms of time. This is something that many people don't pay attention to, is that because the rule about Elliot Wave is that the wave 3 is often the longest and never the shortest. But and wave 4 tend to be the most time consuming. Okay, so you guys need to pay attention to that. You can get something like that, 1, 2, 3, and then you have a 4 like that, and then you have a last wave. Now this is a short time. This can be, let's say, 3 months, and then I should do that differently. Let's go ahead and do another one. You have first wave, retracement, and then wave 3 we go crazy high, and then 4, and we stay like that for a while, and then the last one. Now I'll be like, this thing is pretty long. The wave 3 is the longest, but over time this might be 2 months, but this thing is literally 7 months. In terms of time, the wave 4 tend to be the most time consuming. Not necessarily the longest, definitely not the longest, but definitely most of the time the most time consuming. And after that, Elliot Wave still in it. This is your typical 4. It's it can be ABC in a strong uptrend line. This wave 4 usually create what we call ascending triangle, and we're gonna learn how to trade them in the part 3 of the class properly, nice and clean. Now the wave 5 is the final leg of the general trend. Everyone is bullish. I'll tell you this. Everyone is bullish. The wave 5 is when you name the market, everybody literally link it to money. For an example, in the very last wave on the bull market of Bitcoin, all you have to say is Bitcoin. People will go ahead and look at you, think, oh, money. They literally associated with money. Same thing happened when we had that crazy house bubble. You say I'm buying a house, people think money. Same thing about the dot-com bubble. When we had that, when we were at the very last thing of this thing, the moment you say, oh, they were talking about, oh, you're working at one of these dot-com company, people associate it with money. They see this as a way to get rich. This is the opportunity of the lifetime. Usually everybody talks about it impressive when people who don't even know anything about that stuff. Now the volume on wave 5 often tend to be low than on wave 3, especially in the bull market. Since in the bear market, a volume is not necessarily important to progress the trend. Now, many indicators show divergence. You start having a spreading of bear sign from the lowest time frame to the highest time frame. Big time frame, they tend to persist a little bit more, but you start having a spread of those, a set of bearish signal. For an example, a descending triangle is extremely rare on a bull market. You start having that stuff in the bull market, you need to question yourself, are we in a reversal? You start having that stuff in like 5 minutes, 15 minutes. You don't see a descending triangle in 5-15 minutes on the bull market. It's extremely rare. But when you start having those things a little bit more often, you need to question yourself. Go ahead on a bigger time frame and kind of look around, because maybe we are actually changing direction. So at the end of bull market, bear will be ridiculed. Pay attention. Today is May 20, and I've made this PowerPoint 2 years ago. I never record the class, but this stuff is old, and you can go ahead in every book, you get the same thing. People don't think that stuff will go bad. Everybody's like, this is gonna go up, because that's what it does. It goes up. Now this is the wave 5 when everybody is euphoric. You gotta be careful with that stuff, because bear signs start happening somewhere here. They get more often. They're more persistent. They happen more frequently. For example, in a wave 3, you can be begging for retracement, you never get it. And then, at the very end, you get them a little bit more often. It happen a lot, just way too much, So the bull start losing steam, and boom, next thing you know, bad news, everybody's going down. Now, Elliot wave, corrective wave are characteristic. Generally, the corrective phase happen in three waves. Correction can be a zigzag, something like that. Can be flat, something like that. ABC can be a triangle. For example, you get up, zigzag all the way down, up, ABC flat, or triangle up, A, B, C, and then you get a nice triangle, and then boom, we go up. That is for a bull market. Now, on a wave A, typically more difficult to identify than impulse move. Fundamental news are generally still positive. It's like the beginning of a bull when everything is negative. You just have to reverse everything I said, and then you get the scenario for the bear market. It be associated with a violation of a long time trend line. Usually, for example, you have an impulse like that, and then on this impulse you have that long time uptrend line always being there, and then you break through it. This is a major mistake that I see in the market. People doing this famous head and shoulder thing. You're doing it wrong. Most of them don't realize that one of the shoulders should be in the other side of a major trend line, but that's another thing. We're gonna have to talk about that. So usually it associated with a violation of a long time uptrend, but there's way more than just that. You can have like anywhere between 20 to 30 bear sign and nobody cares. I mean, I've seen this more than once. In a bull market, you have 20 to 30 signs of bear, nobody cares. At the very end of a bear market, you're gonna have like 20 to 30 signs of bull and reversal, nobody cares. It's just the way it is. It's human psychology, human nature. So this is the wave. This is the impulse of the first corrective phase, and then you have the wave B. Now the wave B is famous between day traders and scalpers, especially in low hour time frame. I know a trading strategy when in a bull market. For example, scalpers, they wait for that last wave, the wave 5. Usually the wave 5 is shorter, it's a shy wave, persistent but shy. But when they get that first impulse on corrective wave, they look for that wave, that A. That B is important because usually that B go back somewhere here, somewhere here, because you have like 1, 2, 3, and 4, and then we bounce over it. Usually they like to short that stuff between, some of them use Fibonacci between 61, 50, and 38. We're gonna go over all that, you'll get the point. But it's very famous between scalpers and day traders. Familiar in technical analysis may see the formation of reversal pattern, because obviously it's a correction, so it can't keep going down. The bull market is now clearly in the past. Most people will accept that phase very late. Now the volume in wave B should be lower than wave A, just because the bear don't care about volume most of the time. Fundamental news and sentiment are mixed, with a tendency to the correction acceptation. Overall, gradually people will be like, oh man, I bought the top. A famous thing in here. It's the same thing that happens over and over and over and over. Now, Elliot wave, Elliot correction wave characteristic. So this is the wave B. We're gonna have to talk about the wave C, which is the last one, the the last impulse of the corrective phase. The price move impulsively low, generally in a 5-wave patterns, because you have the A, B, C, and inside of them you get like 1, 3, 4, 5, A, B, C, 1, 2, 3, 4, 5, and that kind of stuff. I don't get into the detail of counting all this stuff, guys. I just don't do that. It's not necessary to catch swings. We don't care about wave in swing trading. So everybody now realize that the bear market is in full bear, and this wave can be very terrible. This is where most people suffer real bad. And this is the last one. This is the last impulse of the entire corrective phase, and this is the primary impulse phase. Now, Elliot Wave fractals. Now, this is where Elliot Wave counters they specialize themselves counting subwave, but like I said, you just won't need that. Okay, fractal naturally occur in nature, as often expand, grow more complex over time. Elliot Wave show the collective human psychology develops in natural pattern. Buying and selling decision now reflects in market price action. You see that? It's just like seashell, galaxy, sunflower, seasons, snowflakes. It's like everything is in everything. We're all bound same order mathematically. So by fractals, I mean this entire thing is an impulse. That's an impulse. That's an impulse. Okay? And that's a correction. Correction. Right? Now in an impulse, everything that is going up, they behave the same way. They have like 5-way up, and then this is a small correction. 5-way up, small correction, and this entire thing is 1-way up, and this entire is a big one. And that's the reason why people need to understand that a third bear market in any market is probably very important, in the sense that a third bear market sets the tone for a major correction of the previous 2 bull run. So you have a bull here, you have a bull here, you have a bull here, you have a bull here. Let me see, here's a bull here. Okay, now these are correction phase and correction phase. The third correction is a correction of this bull, this one, and this one at the same time, and this is why you're gonna have a major impulse all the way down like this. This is the third bear, and we are probably gonna face that in a few months in the cryptocurrency, because we are in 2021 and we already had 2 bears, so this is probably gonna be a third one. Very not normal bear, I'll say. Elliot Wave rules. Wave 2 never retrace 100% of wave 1. Wave 3 is often the longest but never the shortest of the impulsive waves. Wave 4 never overlap the territory of wave 1, except in some pattern or rare pattern formation, and even there usually it's just a week. A big candle, man, that's terrible. I'm drawing this thing. A big candle and a small wick like that, and if that was the first wave, maybe, and usually those big wick happen in big time frames. Okay, so let me finish by saying that Elliot Wave is it's not the most difficult Elliot Wave is one, if not the most difficult concept to master. I think this is the most difficult concept to master. And honestly, if you know have 4 years trading, I doubt that you can be a true Elliot Wave counter, unless this is the only thing you do is study Elliot Wave. Like I said, those books are unbelievably complicated. I don't want to get into the headache of study Elliot Wave. It's not necessarily needed for it's not needed for swing trading strategy, or we don't need it. Now here we present the simple scenario. Like I said, Elliot Wave is complicated. It is way more complicated than this. These are the basic you need for our particular trading style, and I've told you that. And in bear market, all those things that we talk about, you just have to reverse them. And like I said, we're not gonna get into the detail about this. So that's it for Elliot Wave. A little bit shorter lesson than usual, I guess. Yeah, just 30 minutes. So this channel does not intend to replace any trading and coaching program. It's a deep introduction of the world of crypto trading and trading, technical analysis. The series of this channel must not be considered as financial advices. Our content are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. Alright guys, take care. If you did like this video, make sure you subscribe and give us a like. I'll leave some link on Discord channel. You can join me when I literally trade transparently. And alright guys, have a good one. See you in the next lesson. Take care. Bye.